in the money, I must be profitable, right? Not quite. In the money is in reference to the option's strike price relative to the current price of the stock. An in the money option is an option which has intrinsic value. For a call option, that represents an option with a strike lower than the current stock price. For a put option, that represents an option with a strike higher than the current stock price. Being in the money is a good thing for long options. It's not so good for short options. What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
Yeah, it is Thursday, December 5th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. What's going on, everybody? It's going to be a solo show today. You know what that means. It's a highly participatory show, which means shout out to everybody watching on tastylive.com. Shout out to everybody watching inside the platforms, both the desktop and mobile Tasty Trade applications. If you don't already have them, go get them. But if you want to be part of this chat up here on your screen, did I get it? There's only one place that you can do that, and that's heading over to the evil, soon-to-be reformed Google, YouTube. Type in Tasty Live, find the Tasty Live YouTube channel, subscribe to it, and find this big head on a red thumbnail somewhere. Come on in, jump in the chat, tell us where you made money, tell us where you lost money, tell us what you think the payrolls report tomorrow is going to do for the marketplace. Doesn't matter what you say. Type in random ass characters if you want to. Just say something to spoof the Google algorithm and put this little tiny show in front of as many people as possible. Save the world one view at a time. Speaking of the people, speaking of by, of, and for the people, we should say what's up to the people. Shout out to everybody in the YouTube chat. Cactus Leo, Soul Train, Donna. What's up, Donna? Donna saved me from the dead. It's not an exaggeration. A few weeks ago, I was on my deathbed, and she whipped up some witch's brew. And it saved me from the dead. Donna, I owe you my life. V-Dub, what's up? Catan. Am I being hyperbolic? Perhaps. Night Moves, Captain Ruggs, Brian Watson, Dov, Taco Yum, Edward F., V-Dub, and so many more. Thank you, everybody. Thank you for joining it. It's always a pleasure to see you at the end of a trading day. Beginning of in the morning for me, but end of the trading day for all of us. Let's get going here, man. A little bit of a rollover in risk here today, but not what I was looking for. We crossed 100,000, and they backed them up quickly. I didn't think they would do that, so surprised me. Sometimes you're right, sometimes you're wrong. They really smashed MicroStrategy. That's not the biggest surprise in the world. Bonds, a little bit of a lift in the long end. We're going to talk about all that and much more. Payrolls report coming out tomorrow, and is the Tina trade long in the tooth? That's really where I want to go a little bit later. Tina trade meaning there is no alternative. It's what everybody says. It's what everybody uses to justify stretch valuations in America. They just say there is no alternative. I'm going to question whether or not that is true. Before we get there, if any of you have been thinking about or are currently investing or deploying capital outside of U.S. risk markets, tell me which one they are. Let's get that train rolling before we get there. But we are going to get to all of those themes and much, much more. S&P 500, my baby, 6,075, down about 1/5% here today. The NASDAQ, the one I am short down 1/3%. Not as much damage as I was hoping for today, but I'll take it. The Dow Jones was down about 0.5%, and the Russell, of all things, down 1.25%. It was the weakest one here today. Unfortunately, from a sector point of view, just all the wrong things today, quite frankly. From a sector point of view, materials underperformed, which is not good for the good guys over here. Discretionary, staples, energy, utilities, financials, sort of a weird day. Mixed market. Half of the sectors were positive, but not by much. Half the sectors negative. Grumpy Mike says Bitcoin next top 900. Faded the Waymo sell-off and bought more Uber shares. Yeah, they just extended. Donna, speaking about, you guys always get me going off on tangents, but I love it. Uber. So Waymo extended into Miami, or announced their extension into Miami today, and outside of just there, it's just San Francisco, I think, at the moment. It's a positive, obviously, for that company, but a negative then for Uber, who's working on similar technology, right? So you get a little bit of a discount here today. I can't be mad at it, Donna, for using that as an opportunity to get long on that discount. I can't be mad at it at all. I might be joining you tomorrow. What was let's see here. IV rank only 41. Donna says, you can thank my ex-in-laws that taught me that folk remedy tea from their central Mexican mountain village, indigenous medicine. Oh, it cleared it right up 4 days later. Yeah. Edward saying, you all hit the like button. Do me a favor. As you come in, do me a favor and hit the like button. That is greatly appreciated. Back in the 90s, I invested in Euro Disney. I lost everything. Airlines and meme stocks. Airlines went insane. Absolutely insane. United, I think everything was up 3% at one point this morning. They came off their highs, or this morning, United, Delta was up 3%. And I want to say Southwest. Ooh, these things came off a little bit off those highs. Still up 2%. And then Southwest was up 1.5%. End of the day up 2%. Jets is the easiest way to follow these airlines. Most of, if not all, the publicly traded are in that basket, which was up about 3%. Yeah, so two very different stories there. Airlines on the upside and Uber on the downside. But let's get cracking here. As I mentioned, I'm fading the NASDAQ. I'm net long a little bit more of energy and materials and a little bit of China. So today was not the greatest day for the good guys. We managed to stay positive or scratch out the day, which is all right. But that damage they did in materials today was not helpful. The VIX volatility index still 13.5. Still 13.5. So if you want an umbrella, they're selling cheap because it is currently not raining outside. The difficult thing about trying to fade markets at low VIX levels, for all of you that have either heard the conversation on this show or have watched a lot of the Tasty research, when you start to get a low VIX, you have a higher probability of autocorrelation. In other words, a higher probability of trend, a higher probability of continued low volatility. To speak in distribution curves, what that means is you have a sort of a distribution curve with a right lean, a higher probability of an up move, but a fatter left tail. That potential of the VIX spike, or the payout, let's say, of the VIX spike increases, so you get that fatter left tail, but a higher probability of continued inching higher probability of lower fall. So that's the environment we find ourselves in. The pot odds favor the downside move, but the odds in terms of directional move favor the slight upside move. Is how I would interpret the market setup, the distribution curve that we're currently in. but you still got to flip the coin every day, and that's the whole point. Night Move says AAL, or excuse me, Cactus Leo says AAL was up 15%. I missed that one. That's probably the whole catalyst for the whole damn thing. Donaski, not peyote, cinnamon 6, whole star. Oh yeah, you're giving the recipe. Death by 1,000 cuts. All right, let's keep going. Yeah, so VIX cash at 13.5. VIX VIX futures at 14.5. So I guess the way that I think about this, VIX is cheap. What's likely to happen if you were to buy portfolio insurance here is that they will, you're going to lose your money. But the good news is you're going to lose a little bit less money in the environment we're currently in, given the lower price of option premium. So I'm long a little bit of downside NASDAQ puts, super out of the money NASDAQ puts to go along with my sort of short futures deltas for a little convexity and a downside payoff should it ever come. Every time I get excited about a position, when I'm deathly scared, those are the ones that work. When I'm confident and excited about my position each day, it's always rough sledding. Let's take a quick look at the yield curve for just a little bit before we get into some more individual stock ideas, and then our trip around the world to look for opportunities is, come on, baby birds. That's what happens when you're on the other side of the world. Gotta wait a little bit for the data. All right, let's bring up the yield curve this way. Again, I like to show three different yield curves when I look at the yield curve. The red line, basically these are at all points since we've started the cutting cycle. So the red line is September 18th. So on that first cut, 50 basis points, what the yield curve looked like. That second point is November 7th, which is right around the second cut of 25 basis points. And now we have the blue line, which is the current yield curve. And you can see they've done some work on the back end of that yield curve. In other words, since November 7th, we've come down across the curve, but the lower end is falling a bit faster than the short end. So we were at some point in the 10-year at 4.34. We've now got the 10-year at 4.17 and the 30-year at 450, 454, now down to 434, so a drop of 20 basis points or so. So, despite all of the discussion, despite, what we had thought what would happen, which is that long end lift, which did happen up until right about the election, and it carried through a little bit after that. No, I want to say the election was sort of near the peak. And then we get that second cut. We've actually seen an easing in the yield curve here. We've seen an easing in interest rates across the curve. And that's also helping to ease mortgage rates. So mortgage rates have come in ever so slightly. I want to say 20 basis points or so. That's also helping to aid or ease the pain in some of the home builders. But we continue to watch this yield curve. I'm ever so slightly, long ZB. I'm long bonds here. And I don't really know what the upside is. I'm trying to, we had thought last week we get about a 3-point rally in bonds. Where do we take 3 points? It just sounded about right, honestly. We're at the bottom end of that range, which was 115 and change. The top end of that range was about 118 and change. So we just called the idea that we could move from the bottom of that range to the top end of that range or potentially break out. Actually, I think we were midpoint of the range last week. But anyways, the point is we got a 3-point move and we haven't done anything with it. We're just sitting here near 120. And I don't know what the catalyst is for a little bit of a higher move, but I'm hoping, hope is a strategy, I suppose. we've got a couple of catalysts over the next week for movement in the curve, in particular in interest rates. What are those catalysts? One is coming up tomorrow with the payrolls report, and the next one is going to be on December 17th, I believe is the date, which is the next FOMC meeting. Let me double check that date here. 100%, I'm 99% sure, but I don't want to give the wrong date. I'm glad I did. 15th and 16th. So 16th is the date. And so, which is when we get a new FOMC announcement on whether or not they're going to move their policy stance. But we're also going to get a new summary of economic projections. So once a quarter, not only do you get the rate move, not only do you get the statement, not only do you get the Q&A, but you get an additional summary of economic projections and dot plot. So those, in my personal opinion, tend to be that quarterly announcement tends to have it tends to be a little bit more substantive and create the opportunity for more volatility because there's more information. And that more information is the opportunity to either validate what the market has already priced in or to guide the markets away from what they currently have priced in. Guiding away creates volatility, it creates movement. Validating an existing move doesn't really do much. And the question is, and we talked about it over the last couple of days, the summary of economic projections that we are going to be getting on the 16th of December. Do we have the opportunity for some fireworks and for some volatility? Why? Well, they're likely are not going to change this number much, right? Trend growth is 2%. So basically, here's what happens. In the summary of economic projections, each of the FOMC members, they sit down and they write out their projections for growth in the U.S. economy, for unemployment in the U.S. economy, for inflation, both core and headline, and then they write out their projected policy path, so where they think the Fed funds rate is going to be for the next 3 years and over the longer run. And each one of them, they do that, then they put together the ranges with this median. I like to use the median as a shorthand, and that's what we talk about every day, not every day, quite often on this show. So 3 months ago in September, we got one of these things, and that's what we're looking at currently. And we're about to get this new Bible from the Federal Reserve in December. Sorry for the blasphemy. On how to see the world, how to see growth, unemployment, inflation, and the Fed funds rate out into the future. So growth at trend is right around 2%. Unlikely, not impossible, but unlikely they really mess with that too much. Unemployment, is it possible they uptick it, downtick it? Maybe. If anything, I would say probably uptick it. But I don't know that they mess with unemployment too much. We're going to see in the non-farm payrolls on Friday, the expectation, let me pull it up for you, is for an uptick in the unemployment number, I believe from 4.1 to 4.2%. Put it up on your screen. So here's the current unemployment rate, 4.1%. The expectation is for that to slightly uptick to 4.2%. We'll see if that becomes reality. So what motivation would the Fed have to really play with this too much? I'm not sure. Maybe they uptick it to 4.5. I don't think they will. So then the question is, well, where could they put in the changes? And by the way, 2024 is over, right? So in their December projection, we're going to just see 2025, 2026, 2027. We're going to see the next 3 years. What they will likely do, given that PCE inflation and headline inflation is a little bit higher than their projections, they probably are going to uptick 2025. So they got to move these up from 2.2 and 2.1%. They got to move them a little bit higher to reflect reality. And then this little guy, the expectation 3 months ago that they were going to get off to a heavy cutting cycle into the back end of the year with 100 basis points of cuts into 2024, but then really get moving in 2025 and aggressively or quickly lower the Fed funds rate, and we'd get down to 3.4%. If you can remember, at the time this was coming out, the 2-year was right around 3.5%, if I'm not mistaken. Let's go back into the platform. We can show you. Let's look at the 2-year yield. That's why I love these futures. We'll look at the continuous contract here by typing in the $ beforehand. That way we get the active contract month for each one of these. We'll let this load, and I'll come back and we'll finish our point here. But the point is, as we go back in time towards September, the 2-year yield is effectively telling you what it is projecting the Fed to do in a way, in sort of a roundabout way. And that has come from 3.5% in the 2-year yield to somewhere north of 4%. So likely you see them do the exact same thing. They've got to probably true this up a little bit to where the market perception is, and the same thing with 2026. So those are the likely changes. It's just to what extent, how aggressive will they be in moving this Fed funds rate, and likely this is a lot of people are going to be looking at this number. This number where the Fed funds rate is long run. I think a lot of eyes are going to be on how people or what number they put here. This is sort of like a proxy for their long run neutral rate. And so the likelihood that they move this up, they're going to move up their inflation targets. But the big question in my mind, the more I sat with it, is what do they do with this? They likely continue to move up that longer run rate, but how aggressively to the upside, and that will determine sort of like the market's comfort level. If that goes too high, the market could get uncomfortable. Let's give you, here's our 2 years. We go back to September, look at the rate in September, right around 3.5%. So this is how you get a summary of economic projections, where all the FOMC members, they wake up, they look at the 2 year, and they go, oh, the 2 years right around 3.5. So the market is basically projecting where we see this rate over the next couple of years. So guess what I'm going to put on my bingo board? I'm going to put the same damn thing. 3.1 to 3.6% was the range, which is all structured right around where that 2 year is. And so now we're at around 4.1%. Where do you think this is going to be? So the question is, do they bless what the market has already priced, or do they try to guide it somewhere where it is not? If it tries to guide it somewhere, we're going to see more vol. That doesn't mean downside. It just means we're going to see the market have to jump to move to meet their pricing. Or are they just going to bless what we've already seen in the marketplace? That's the big question going into the 16th. Let me pause for a second, see what you guys are squawking about in the chat before we start talking some other concepts here. USA, much more difficult. Even with you're still talking about going to the doctor. You're still talking about your special elixirs in the chat. Can we hack into Jerome's phone and change the parameters of the dot plot? First of all, hilarious. Second of all, if you could change it, what would you change it to? Third of all, it's funny that we now say hack into his phone. I think back in the day when it was Greenspan, they sort of had this, I don't want to say it was a game, but they would look at the size of Alan Greenspan's briefcase that he would carry. And depending on whether or not the briefcase looked thick or thin, people would take that and try to front run whether or not they felt they were going to cut rates or not. So it's kind of funny that we've gone from a world where an analog world, how big is the briefcase, to can we hack into the guy's phone, for analog to digital. A quick aside. Anyway, all that yield curve stuff and SEP was just to say there's a couple of catalysts on the calendar over the next couple of weeks. Those catalysts could work in my favor or not, or we could just see a vol crush and the market trade sideways. That's in the cards as well. But I'm slightly long bond deltas, hoping to get paid. I don't love being long bonds. I think I had this conversation with Tony and Tom earlier. I think in a year, do I think interest rates are higher or lower? I'd probably guess they're higher. The 10-year is higher. and the 2 years much lower. I would guess a steepening, but from now until 2025. We've talked about this before, but just in case this concept is new to anybody, this is the 2 versus the 10-year. So this is the difference between the 2s and the 10s, the 2-year yield and the 10-year yield. I'll just do this really quickly, but the long-term average is right around 100 basis points. So 1% is the normal distance between them. And the current distance is about, I don't think that's right. Let me refresh this. It's 2 basis points. So there's almost no difference between the yield in the 2-year and the 10-year. Think about what that means. Usually, like if you're going to loan me money, okay, and you say, Victor, when are you going to pay me back? And I say, I'll pay back on Friday. Go, okay, here you go. Pay me back an extra quarter in interest, something like this. We actually do percentages. So this example actually makes sense. Let's do it this way. You're going to lend me money. And you say, when are you going to pay me back? And I say, in 2 years. You go, okay, I'm going to lend you this money at 4% interest. I can say, okay, that sounds fair. If I say, I want to borrow this money, you say, for how long? And I say, for 10 years. Would you loan it to me at 4%, the same amount? Normally, you wouldn't. Normally, you'd want additional premium for the additional risk that you're taking. There's more default risk. There's more things that could go wrong with that loan from your point of view over 10 years than over 2 years. There's more, anything could happen with the money. The money that I pay you back in 10 years may not be worth the money that you loaned me. So you're going to want to account for all of those things. And you would account for it by charging me more for the money. So perhaps you don't loan it to me at 4%, you'd loan it to me at 5% for 10 years. So what I'm telling you is, and what this chart is saying, is that over the long-term average since the 80s, or the late 70s when the 2s were introduced, the average distance between the 2-year and the 10-year is 100 basis points, or 1%, or the average amount that you would add on for the additional time of lending money over 10 years versus 2 is about 1%. So my bet is that we're in this weird, funky place, right? And an inversion is a funky place. You don't tend to stay there very long, even though our last inversion was, I think, the longest in history since the 2s were introduced. But we did eventually uninvert. And do I think we're going to stay flat for 10 years? No. Do I think we're going to 100 basis points right away? I don't know that that's true either. So, but I would bet over a year, and this is a hard bet to put on, but I would bet we see a steepening between the 2s and the 10s from now until, December 5th of 2025. We come back here, we're having the same type of conversation. That would be my bet. All right, let's keep cruising here. So that's my quick rant on interest rates. It's messy hair for Powell. That's the hilarious thing to me too, is people always talk about Powell's demeanor. To me, that's such witchcraft. Who the hell cares? And I know this is people are dealing with lots of money, so you're looking for any edge you can. And in a way, if you're sitting at a poker table, you're trying to understand whether the person across from you, are they nervous? Do they have a tell? So I get that mentality, but I don't really think that's very helpful. Like, was he confident? Was he stuttering? Did he look nervous? Did he look tired? To me, that's all just stupid conjecture. It doesn't matter at all. It's just stuff to fill the time with nothing, fill the air times with nothing. But the current expectations are that we're going to get a cut in December. 70% probability, which came down. Yesterday we were at 78%. It came down a bit to 70%. But that's still, I think, Chris Vecchio's done the math. I think anything above 55%, and the market or the Federal Reserve has never gone against the market when it's had a 55% probability or above. So we're currently in a territory that it's unlikely, unless we get an article out from Nick Timmeros, or unless we start getting statements from Powell that they want to move the other direction. I think it's highly likely that you're going to see a cut here. On the 16th, the only question is, what kind of cut is it? You know, is it a dovish cut or is it a hawkish cut? Some part of me thinks it doesn't matter whether they cut or they do not. I'm playing the rally in bonds into or after it. And the reason for that is, regardless of if they cut or they do not cut, we're going to enter a new regime. That new regime is much less interest rate cuts. And less interest rate cuts will mean, from the market's perspective, less fear of inflation. And the only question is, what I'm saying is what I'm saying already priced into the market, or are there a few points left to be had in bonds once we get there? So once we get to the point where, like, all right, they've front loaded 100 basis points into December of cuts, and now that we're through that, the SEP is probably going to say that they're going to cut twice next year, because that's what the markets are priced right now, somewhere between 2 and 3 cuts next year. So if the SEP says that, you go from 100 basis points and expecting a ton of cuts in 2025 to 100 basis points or 75 regardless, and then only expecting 2 more cuts next year. That's a big difference. And your expectations around inflation should be very different in that scenario, and I think they are changing. I think that's one of the reasons why materials is getting a little bit weaker here. I think that's one of the reasons you've seen a lot of the commodities get hit a little bit, because those expectations for how to think about the world in 2025 are now getting solidified and priced in. And the only question is, what's priced into bonds? Do we got another point or two to squeeze? I'm going to bet that we do. I don't know if the risk reward makes a lot of sense, you know, if we've got 1 or 2 points of upside, but how many points of downside do we have? I don't know. Let me guess it's 50-50. 2 points in either direction. So I'm betting it. That's a long way to say this is how I'm betting it, and this is what my thinking is. So catalyst on payrolls and catalyst on FOMC. We shall see. Likely, I'm going to come back here. I keep making this joke, but likely I'm going to come back here. The meeting's on the 16th. I'm going to come back here on the 17th and say, I was so wrong. Why didn't you guys stop me? I'm going to blame it on you guys. Powell bikes to the office. Is that true, Brian? I love that. If that's true, I love it. Donna says, everything feels too complacent. Too many people thinking SPY and QQQ will go up forever. Not enough fear of a correction. I agree with that, Donna. But also, the fade here is too easy. That's what I'm concerned about. You know what I'm saying? I think most of us, any rational, reasonable person, would look at the S&P chart. They would look at S&P valuations. They would look at the SMH, or the semiconductor ETF. What was I just looking at? Oh, you could look at the spread between the U.S. and other markets. Like, every measure you look at, this thing is stretched. And so when that happens, it becomes really easy to fade. And the easy trade always gets run over. So that's why I'm a little bit concerned. Do I think they're stretched? Yes. Do I think we should correct 5 to 10% to get more attractive prices as fuel to get to more attractive levels? Yes. But it's kind of too easy, and that's why I'm not sure it's going to work this time around. Brian says, I watched an interview years ago with Powell, and he said it made him upset seeing the homeless people. Oh, my, give me a break. Give me a break. As he rode his bicycle to the office. Yeah. I didn't want to go there. Now, irony of $100 million man flooding the marketplace with trillions of dollars, which is going to drop a bunch of people in poverty into severe poverty, and the middle class into poverty. Talking about doing his little job. Now I don't like it. I liked it, the riding the bike, but to give some like virtuous reason why. You know what else? You know what would help? You know what helped the homeless, Jerome Powell? Take some of the $100 million you have and do something about it. Maybe the bicycle thing is, it's a good start. Sorry. Cactus Leo says 100,000 was an easy target. Now what? All right, I'll go there before I go to the Tina trade rant. So I'm gonna eat a slice of humble pie here. Because though I don't know, they haven't done enough damage in Bitcoin to say that this isn't still consolidating around 95,000. I sort of thought a move above 100 would be sustained for a little bit. I thought we would go kind of 100, 105, then go dumb, 110, 115. To get this this big reversal candle on the day that it cracks 100,000, the day after, I should say. Technically, we crossed since yesterday. All my days are mixed up. I'm 14 hours ahead here, so my days get all messed up. But I thought we'd stay above 100,000 a little bit longer. I thought we'd get the hook as soon as we cross. That being said, to come back to 96,000, this could still be part of the consolidation. I just don't think it's done. It would be strange to me. It's like too easy just to go to 100,000 and flip around. I don't think it's done. I'm still long. I didn't sell 100,000, mostly because I'm greedy. But I think anything north of 110, I probably will. So I'm trying to eke out another 10%. That's how you know I'm too greedy and this isn't going to work. But this is a trade, not the whole. So there's a position that I hold in Bitcoin. I do not trade around. For all you Bitcoin maxis out there, why would you ever sell your Bitcoin? There's a position that I hold, and then I like to trade around Bitcoin as well. In that traded position, we've been in since early October, 61.5. This is when MicroStrategy had this real big breakout. There was a divergence between MicroStrategy breaking out and Bitcoin price. And really, we had no other smart reason than just trading that divergence. And it was basically FOMO. It was like, well, what's happening over here? And if that's breaking out, this has got to respond. And if it does respond, I want to be part of it. And so we've got a nice little ripper here from 61.5, I think was the entry. Once we got up to 99, it pulled back to 92, I want to say. This was entry point number 2. And now we're just kind of waiting to see if we can rally up past 110. And I said on a pullback to like 88, that's probably where we exit the position if we can't get our upside target of 110, close to 110. Not the exact round number, right? I'm not going to wait for it to hit 110 on the dot. I'm not going to play into round number bias, but we are looking for about 110 on the upside, and then we'll abandon it 88 on the downside because that's still profitable for us anyway. Let's see what you guys are saying real quick before I go on to the next topic. If ChatGPT can replace everyone's jobs, the market is underpriced for the productivity unlocked. I agree, absolute beginner. But have you, I use ChatGPT. It's good, and I know it's learning quickly. I don't think it's close to taking my job. And I don't really, I don't know what it is that I do here, but I don't think it's that close. It's getting better. But I think the promise, if I take myself back 2 years and I think about where I thought it would be 2 years later, I don't think it's advanced at the pace. I don't think it's unlocked the productivity that I would have guessed for myself personally. There's a lot of stuff that I use it for, and it is very helpful. It does save me time, but I don't think it's unlocked some massive amount of productivity for me personally. Am I the only one? Can you guys speak to this, please? Take yourself back 2 years ago and how you thought about AI and what you thought it would do over a 2-year period, how quickly it would happen, the disruption that you thought you would see in your own personal lives and the personal lives of others, and not even just disruption. That's the negative connotation. Let's call it productivity, unlocking of productivity in your own life. Do you think 2 years later that it has met or exceeded those expectations, or has it undershot those expectations? What is it for you? I'm curious. To me, I expected more and I expected faster. Maybe I'm just not using it right. GME popping off today, so I had to snag a 0 DTE. Oh, that's what we're doing? 6%? If ChatGPT, we already read that one. 100% Victor, Powell virtue signaling while printer goes burr with well-known ramifications of exactly, Chris. Like, give me a break. Just say I ride my bike and I do it for the environment, or just say I ride my bike. Don't put out that other thing to try to make people, oh, you're a great guy. 122K-ish is the cup and handle measured move level. Is it absolute? Thank you very much. Might adjust my upside. I'm just kidding. Solid from the core. Long live BTC. What's up, brother? Whatever happened to your platform? Doe. What's going on, boss of the South? Tasty was acquired by IG. And on that acquisition, that application was sort of transitioned into the core of what is now Bad Trader. But we decided not to hold two different brokerage firms in the U.S. anymore. So it was consolidated. Max Virtual One, it makes so many simple mistakes. I don't know what you mean. Oh, I get what you're saying. Yes, so many simple mistakes. I agree. You're talking about ChatGPT. Donna says ChatGPT is more likely to assist customer service employees but not replace higher level employees. Chris Connolly saying demos well and is amazing, but is an augmenter of professionals' expertise, not a replacement, undershot and way expensive. I totally. That's a great way to say it. I try all the time to take on, because I have big tasks, big projects with pretty meaty analysis that I want to do. And I don't want to do it by hand, and I don't necessarily want to hire a researcher. And they would take, probably weeks worth of work. And so I tried to split that up into smaller units of work and feed that to ChatGPT. And I just I can't get the quality of output that I would like in order to feel confident of doing the whole project. So I can't. I think a lot of people use it for Twitter posts. They all sound the same. Space Explorer says it's pretty good. I agree it's pretty good. I do agree it's good. I do agree it's helpful. It's not like I want to be very clear. This isn't a dunk on ChatGPT like segment. What I'm trying to do is gauge, just like markets are always, what is reality relative to the expectation? I'm trying to gauge what is the reality of ChatGPT 2 years later, relative to your own personal expectations. That's all I want to do. And to me, I had grand expectations for what this would look like and how quickly it would progress. But I still find myself unable to do some of the work that I would want to use ChatGPT for. So it's sort of a waiting game as it develops further. Glad I went short duration and way wide Alta and Lulu. Yeah, the Lulu moves have been insane. So Alta as well. I've asked Google AI questions, just a couple more, and then we'll move on. Google AI questions about stocks, but it frequently gets the financial year wrong in the answers, so the answers are useless. I've tried to do real simple stuff, like I'll talk about, or I'll ask it about yield curve. Explain the yield curve, explain what the yield curve looked like on this date versus this date. What does that mean? Like, I've tried to do kind of relatively simple stuff, what I would interpret as simple. And I don't know, it just doesn't handle it well. But I did spend like 18 hours once because I just wanted to see how good its development was. So I used to be in product management. So the idea of like putting together some detailed requirements and giving it to a developer, then to have the developer do the work, I've gone through that before. So I was like, let me dust off those product management skills, write some super specific requirements and see how good this thing does. It took me 18 hours to get what I thought was a low-level program written. But it did it did a decent job. It took forever. AI is good for summarizing, but still give biased information. Yeah, I agree. All right, last couple. Yeah, the bigger project, the harder it is to get it to work. For small things, it's almost perfect. But I think it's mostly us that need to learn to unlock it. Yeah, I agree. But if the upfront work, if it takes so much time to sit down and think through how to structure out the work so that you can get the output, the question is whether it's actually a time save. So I'm with you. There probably is some time save there, but not to the extent what people are expecting or hoping for. All right, let's talk about something real quick. I was interested in obviously I've been asking Chris and Ilya this week. I've been asking them about Tina, and there's a reason I've been asking them about Tina and whether they believe there is no alternative. Do you continue to put an incremental dollar in U.S. markets, or do you look for alternatives? There's a reason I've been asking that question, because I personally have been asking myself that question, and I've been starting to look at outside of China, which got super cheap for reasons we all know and understand at this point, and we also saw some correction in the deep discount that was priced into China. What else? Is there anything else that looks attractive? And I think the answer probably is nothing as attractive as the deep discount that was put into China. But I was curious. So what I've got in front of you today, I'm going to put up. What production is going to help me put up in front of you is the performance of several countries' ETF year to date. Excuse me, I've got heartburn like crazy. So again, these are several countries' performance year to date, and I was curious what was outperforming and what was underperforming for the year. If this is harder to see, I'll try. Let me see is there any way for me to zoom in? Hopefully you guys can see this. But I'm looking at this bottom segment here. So Argentina's up 65%. It is the leader, but that should surprise anybody because of what's happening with inflation and their money over there. I think it's up in the last 3 years, up like 300% or something. 200%. So year to date, Argentina is the leader. Peru up 30%. United States up 28.8%. So S&P is up around 30%. Israel on the other side of the board up 32% over here on this side as well. And again, these are individual countries. You're not going to see Europe as a whole, but we can go through these. You can kind of see Taiwan up 20%, China up 14%. Again, all of this take relative to the U.S. at 29%, because that's really what we're talking about. So what was the discount or what was the outperformance in the United States relative to some of these other countries? India up 14%, Japan up 11.5%, And as you go across, Europe, those returns are even more muted, to say the least. And then some places in Middle East, pretty muted returns as well. UAE up 8%, Qatar up 4%, Saudi Arabia basically a big scratch. And where you have perhaps discount, I want to be careful about saying discount, but France, obviously with what they're going through in political turmoil, is creating a bit of discount. In France, South Korea is down 16%. What a S show over the last week. I still can't exactly wrap my mind around what's happening there, but it seems like there's a president who's trying to hold on to power and a constituency and representation that doesn't want that person in power. And so it looks like they're trying to impeach, and he tried to front run that impeachment with a declaration of martial law. Is my understanding correct? That's kind of what I understand to be happening right now. So South Korea down 15%. So some part of me is going, okay, is there opportunity there? Because some sick part of my brain has to look at everything through that lens. Uncheck all these. And then the bigger ones I was more interested in because of how they started the year was Mexico and Brazil. Mexico down 22%, Brazil down 23.5%. Korean spice, maybe. Brian Watson says, yeah. So yeah, I think I'm on the right track. I'm trying to get these visuals right so we can see. There we go. I want America, Chile, Mexico, Brazil, and France. So my question is, some of these aren't optionable. Some of them don't have great liquidity in the options market. But I am curious, EWY, EWW, and EWZ. Let's see can we trade martial law. Is there a trade in the declaration of martial law? Let us see. I think these oh god, I knew these option markets were going to be kind of disgusting. These are worse than I expected. So the tough part here is if you can basically drive a truck through these spreads. And so for anyone that hasn't made that mistake before, the tough part about executing is you might be able to get in somewhere near fair value. And you might be able to put your position on somewhere near fair value. But the problem is when the volume looks like this and the open interest looks like this, there's nothing. And let's say the market moves in your direction. Let's just say we buy the 55-60 call spread. Oh my God, it's so disgusting. Let's just say for whatever reason we buy the 55 calls. The market moves in our direction. The problem is though, that while we might have gotten in near fair value, when we go to exit and the market can see that this is a position to close on a line with nearly no open interest, do you think you're going to get close to fair value? You are not, my friend. They're going to rip your eyeballs out trying to get out of the position. They call it the Hotel California, which is one of the reasons why, a main reason why Tasty is so adamant about finding liquid markets. So you're not giving up edge to the marketplace. So in other words, all the work that you did to amass that gain in delta, you're just going to give it back in edge back to the market in the spread. Unfortunately, there's not much here to do in the options market unless you're willing to take a bet directly in equity. And I kind of am. Some part of me does want to take a little bit of a bet here on South Korea. Do I sound insane? Same thing with EWW, which is Mexico. On a monthly basis, this thing's what? Probably 30% off its highs. For the year, though, it's gone one direction, and that's down. And then EWZ, in terms of Brazil, and I get the negative setups for all of these, the reasons why. But as you know, like sometimes we play for the cycle, right? The 30 or 45 days in front of us. And sometimes I personally am just looking for stuff that's beaten up. Just like I think it was Donna earlier said, she went long a little bit of Uber given the discount that they priced into Waymo today. That's the exact same way that I think. These country ETFs, they tend to have really low betas on them, so they're not going to move around a ton. I think I already own some India, which isn't super liquid either, but INDA. I've owned this for a little bit of time. I think I own some VGK, which is Europe. And I wonder if it's the time to start adding things like South Korea, like Mexico, and like Brazil. I'm not saying that this is the bottom in any way, shape, or form. And the way that I usually do this is I start adding just little increments at a time to build a position. I usually only like to do it on instruments that have liquid options. That way I can reduce my basis through selling volatility against the position. But in this, sometimes I make exceptions. In this case, if I was interested in South Korea, I would have to make an exception. I wonder if there's anything with a bit more liquidity here, though. That's what I didn't check before the show. 1 second. I don't think so. I think this is going to end up being my most liquid option. By a long shot. The next one's not even close. The next one's this one. FLKR, which has almost no assets under management. So basically, this is the only way you can trade martial law through this instrument. And I think I'm going to. So the goal of this show is to show that you can turn any news headline into a trade into a trade idea. Someone is trying to unite the Korean peninsula. South Korea makes good quality EV batteries. I think Nubank is good liquid option to get long South America. Appreciate that zero expiration. I would take a look at that one tonight as well. Yeah, I wish all of the underlyings here, all of the underlying holdings, really, I don't think are tradable on U.S. markets either. Like Samsung Electronics, KB Financial Group, Hyundai, Celltrion, Kia. There's a bunch of these holding corporations. So that's how South Korea does it, but I'm not familiar with like an individual name, like Alibaba or a Baidu that we could just go into and trade directly through via ADRs. So I think this is going to be my only option. The best day to have done this was 2 days ago on the 3rd. This thing traded all the way below 54, but you're still getting discount here. So I think I'm going to start building a little teeny tiny position. What say the chat? Am I a crazy person for getting involved in this instrument with low liquidity, or just the idea of South Korea right now, given its potential volatility and unknown future? Or is this what you watch for, these types of crazy ideas to make you go, I didn't think about that. Probably would have been better 2 days ago, though. All right. Let's go to our last topic, I kind of buzzed through these pretty quickly. Not a ton here today in terms of economic data. Tomorrow, obviously, is a big day. So there's a little bit of repositioning today. Not much, mostly in the Russell. What does that mean? Preparing for a low number. Did somebody get the data early? So you take your risk out of small caps. So the prior number was 12,000. I think most people read through that as perhaps hurricane related. And now the consensus 211,000 for tomorrow's number. Did that bump up just a little bit? I thought it was 200,000 going into the week, with a slight bump in unemployment expected 4.2%. And the inflation numbers people are going to be paying attention to as well. I find it fascinating that nobody cares about this participation rate. That's really, people always look at this unemployment rate. This is the part where I rant about econometrics for a second. People always talk about, especially our politicians, they talk about that unemployment rate. But the unemployment rate was designed so that people who are looking for a job and can't find a job inside of 12 months, they drop them out of this number. So all the discouraged people looking for a job aren't included here. To me, I find it much more interesting, like, why don't we as a society care about the labor force participation rate, which has dropped ever since the proliferation of the internet in the early 2000s? So as we become more efficient, as we create more automation away from low-skilled work, the idea is always, this is what everyone always says, oh yes, but we create new, different jobs. Okay, I get that in theory. That works in theory. But does anyone care that the labor force participation rate has continued downward pressure since its high in the year 2000? How do you explain that? No one tries. But that's where all those tents come from in the cities. I'm sorry, I don't know why I got negative. Average hourly earnings month over month expectation 0.3%. Year over year at 3.9%. And this is another area where people look for inflation. Once it's here in wages, it's entrenched. Or it's said to be entrenched. You're in a little bit of a wage price spiral. So we've been at elevated earnings levels here, but it's not crazy. Quite frankly, there's a part of me that goes, I don't know that the debt is a problem as much as stagnant wages are the problem. Get what I'm saying? Like, if we got to $36 trillion in debt with the speed that we did, but there was a bit more wage growth for the populace, and I know that what if is really hard because you can't do that ceteris paribus, because if you had higher wage growth, what would that have meant for inflation the whole period of time? Because likely of higher velocity of money in that case, when more money goes to the populace. But ceteris paribus, I wonder if we had higher wage growth for the last 20 years, throughout ZERP, would this debt level be as problematic as it is right now? I'm not certain, and that's sort of an unanswerable, unknowable question. So, but that is the big focus tomorrow. I think I'm going to play this long bonds regardless. Do I think it's possible that the economy adds 275,000 jobs towards the top end of this range? It's possible. I'd probably bet less. I'd bet below the consensus. And if so, maybe that's a little bit, maybe that gives us our extra point in bonds, gets us back above 120 and lets me to start exiting some of my long bond deltas. We shall see. Godspeed to all of you. regardless if you're on the long bond or short bond trade or not. Victor, why do you talk about bonds so much? It's because, to me, I think that's where I'm comfortable right now. To me, I think equities are so rich and the left tail is so fat. I can't help myself but try to participate on the pot odds of a downside move, but I'm also not confident in it, and I don't want to bet the farm trying to fade a marketplace at the beginning of a cutting cycle. I don't know that I want to do that. So I'm there in case we get a big move. I've got some convex bets that'll pay off, but otherwise, on a day-to-day basis, I like the bond market. Seems a bit safer. So that's where I am. That's going to do it for us today. We went through our topics a bit quicker, which also means that's going to do it for us for the week. So do me a favor, hit the like button before you get out of here. Subscribe to the channel if you haven't already. A couple more comments before I leave. Negative number coming. You think so, Knight? You think that's what that little down move in the Russell signaling? Somebody got ahead of it. Who knows? Crypto is a South Korea proxy. Something like 10% of crypto volumes come from South Korea. Yeah. A lot of it in Ripple, though, isn't it? A lot of it's not directly in Bitcoin, if I'm not mistaken. Millions of people outside the formal workforce. Sort of. I agree with that, but the non-farm payrolls, they come. Those are surveys. Those are survey based. So there's establishment survey and household survey. So just because you don't get formally paid through like W-2 or something like that, it doesn't necessarily mean that those people aren't captured in these surveys. U6 unemployment number is so much more accurate in capturing than the U3 number we all go by. I agree, but I just think zero. I do agree. I think, though, I mean, they just say different things. Here's what the unemployment is designed to say. If you can't get a job in a year, then that's your fault. If you can't get a job in 3 months, it's the economy's fault. And so there's this rolling window that says from 0 to 12 months, that's on the economy. Anything longer than 12 months, that's on you. You have a skills mismatch for the economy, and you need to do something about that skills match to be able to re-enter the workforce and sell labor. That's the theory behind it, right or wrong. But and I don't necessarily want to change the number. What I wish we did is gave people more context to what that number actually means, because I think people go around saying lowest unemployment in history. Well, that could be good, or it could mean you had the most discouraged workforce. That could be what that means. You had the most amount of people that gave up looking for jobs, or they couldn't find jobs inside of a year, and so that number is the lowest. That could be what that means. It doesn't necessarily mean that the lowest unemployment number is a sign that you created a really strong economy. It could mean that you had the most discouraged workforce of all time. And so I think, like, talking about getting people back to work, to me, that is, well, what did you do to the labor? What did your policies do to the labor force participation rate? How many people did you pull out of not being a part of the labor force back into the labor force? Maybe I'm being too idealistic, but I think for what people try to talk about, the points that they're trying to communicate when they're talking about that unemployment number, mostly they would be better talking about the labor force participation rate, but they're not going to do that because it doesn't tell the story that they want to tell. So they use the statistic that allows them to tell the story that they want. And because I think, generally speaking, we don't have a strong enough understanding of what that number actually means, they get away with it. Oh, okay, I guess the unemployment rate is low, so the economy must be strong. I guess they're doing a good job. But anyways, all right, I'll get off my soapbox. Holiday temporary worker hiring. Yeah, that's the flip side of this. But the problem is, Brian, I don't, you look at like companies like Foot Locker and Dollar Tree, and I know they're not necessarily representative of the entire workforce, but a lot of these individual companies are putting out soft expectations, soft guidance about the future. We shall see. All right, everybody. I will catch you back here next week, bright and early on Monday. Same time, same place, same great network, only on Tasty Live. Until then, I've been Victor Jones. Peace.